We are diving straight into the Q3 2025 financial results and the business update for Lisata Therapeutics. That's ticker LSTA.
And if you track the biotech space, this was a really interesting one.
It was a masterclass in contradiction, I think. We saw, clear evidence of scientific progress, some really solid expense discipline, and an earnings beat.
Yep.
And yet the market reacted like a total disaster was on the horizon. The stock just tumbled.
It was a classic case of good news, but, management gave us these fantastic clinical milestones. They proved they could narrow their net loss.
Right.
But investors, they just weren't listening to the science or even the financials, really. Their ears were ringing with the sound of just one question.
Where is the money for phase 3 coming from?
Exactly.
So that's our mission today. We are going to meticulously unpack this disconnect. We want to understand why all this positive performance led to such a sharp sell-off. I think it closed about 12.3% lower the day after the call.
It was a big drop.
Let's start with the hard numbers, the numbers that, surprisingly failed to impress anyone.
Okay, so if we look at the headline financials for Q3 2025, Lisata actually delivered a small but pretty important beat. They reported GAAP EPS of negative 49 cents.
And the street was expecting worse than that.
Oh, yeah. Consensus was looking for something closer to negative 54 cents. So that's about a 9% positive surprise. And it's a solid improvement from the negative 59 cents they lost in the same quarter last year.
So an earnings beat and a narrowing loss, that usually signals some decent operational health, even for a clinical stage company.
Absolutely. The net loss narrowed to $4.2 million, which is down from $4.9 million year over year. Now, revenue was zero, which for anyone new to biotech, that is perfectly normal.
They're not selling anything yet.
Exactly. They're focused entirely on development. So the key metric isn't revenue, it's cash management. And that brings us straight to their focus on expense discipline.
And management really made a point of stressing that cost control, which you have to do when there's no money coming in the door.
And they executed flawlessly on that. Total operating expenses, they dropped a substantial 17.3% year over year, came in at $4.4 million compared to $5.3 million previously.
Okay, so where did they make those cuts? Walk us through it, especially on the R&D side.
Sure. R&D expenses specifically, they fell almost 23% year over year to $2.00 million. The main drivers for this were lower spending on CMC, that's chemistry, manufacturing, and controls, and reduced clinical department expenses.
Now, CMC is basically the complex, expensive part of getting a drug ready for mass production, right?
It is. It's vital stuff. So reducing those costs while still pushing trials forward, that says a lot about their efficiency. They're leaning on investigator-initiated trials instead of these huge, expensive programs they have to fund themselves.
It suggests they're running a very tight ship. They're focused only on what's essential to generate data.
Precisely. And G&A expenses also dropped, about 12.1% year over year. They tied that to lower consulting fees and some targeted headcount reductions.
And all of this tightening, it was all aimed at one thing.
Stretching the cash runway.
Which is where all the market anxiety starts to creep in.
Yeah.
So what is the current runway guidance?
As of the end of Q3, the company had $19.0 million in cash and equivalents, and importantly, zero debt. Management stated that these funds will support current operations into Q1 of 2027.
That sounds pretty good on the surface. A runway of over a year gives you some breathing room.
It does, but when management gives that projection, what's the massive critical element they're deliberately leaving out?
The thing that's making investors so nervous.
The caveat, and it is a big one, that Q1 2027 projection does not include the huge amount of capital they'll need for a potential phase 3 trial for their lead program, ASCEND.
And that's for metastatic pancreatic cancer, MPDAs.
Correct. A pivotal phase 3 oncology trial can cost tens, sometimes hundreds of millions of dollars. That runway is great for maintaining what they're doing now, but it's nowhere near enough to start the next most crucial step.
So the market is trading on a capital need that is known, that is massive, and that is explicitly not funded. What did management say about bridging that gap?
They were very clear. They are strongly preferring non-dilutive financing or a partnership to fund that study.
Okay.
The CEO even said that raising the full amount on their own in this market would be, and I quote, distasteful, which is code for.
Yeah.
We would have to raise so much money we'd severely dilute our current shareholders.
And shareholders appreciate hearing that. calling dilution distasteful, but it also means your whole strategy hinges on a big pharma partnership or a licensing deal materializing.
And soon, the market is basically demanding proof of that partnership now, no matter how good the science is.
It's like they're saying the science is promising, but the cost to get to the finish line is too high for you alone. Show us the partner. So let's pivot to the part of the story management believes the market is just completely ignoring the science. Is the data actually strong enough to justify this huge financial risk? Let's talk about certepetide.
It's a fascinating asset. It's a cyclic internalizing RGD peptide. The simplest way to think of it is as a tiny molecular delivery truck.
Delivery truck.
Yeah, its mechanism is unique.
Yeah.
It activates this novel pathway that lets it selectively get inside dense, solid tumors.
And why is that so difficult? What does that mean for the tumor microenvironment, the TME?
Well, solid tumors, especially pancreatic cancer, they have this thick, fibrotic shell. It's like a concrete bunker. Most drugs just bounce off. Certepetide gets inside the bunker, and this is the crucial part, it remodels the environment inside.
How so?
It takes a tumor that is immunocold, meaning the immune system can't see it or attack it, and it turns it immunohot. And it makes it vulnerable to other treatments, including immunotherapies. It's a backbone therapy designed to make other drugs work better.
Okay, so let's get into the data that supports this, starting with the lead program, ASCEND.
This is the high-stakes one. The final pool data from cohorts A and B, that's expected in Q1 2026. But the data they presented at the ESMO conference already showed these really encouraging trends in overall survival and progression-free survival.
But there was one statistic that really should have grabbed everyone's attention.
The 5 total complete responses, CRs. They saw 5 in the certepetide treatment groups.
5 complete responses. For listeners who don't follow oncology that closely, how big of a deal is that in metastatic pancreatic cancer?
It is hugely significant. I mean, this is a notoriously lethal cancer. Standard of care is often just about slowing things down, extending life by a few months. A complete response means all signs of the cancer are gone.
And they saw 5.
5. In phase 2, across 2 cohorts, compared to 0 in the standard of care or placebo group, that suggests a real, tangible clinical benefit. It validates the whole mechanism.
And they're not just sitting on that data. They already have an agreement with the FDA on what a global phase 3 would look like. They're just waiting for the funding. They're ready to go.
That preparation is key. And while everyone's waiting for the final ASCEND data, they've also accelerated another trial, BOLSTER.
Right. In cholangiocarcinoma, the first-line cohort finished enrollment about 6 months ahead of schedule. That's a huge operational win.
It is, and it pulls the top-line data readout forward into Q4 2025.
So that's an immediate catalyst for investors to watch.
A hard catalyst.
Yeah.
And they did it while keeping their expenses tight. They also fully enrolled a smaller second-line cohort, which just, emphasizes their capital efficiency.
And we can't forget the Sendifox trial. This is in the neoadjuvant setting, so treating cancer before surgery.
And this is where that whole TME modification thing really shines. The early PDAK data showed these remarkable rates of surgical success, specifically a 50% R0 resection rate.
Can you define R0 resection for us?
Sure. It means the surgeon was able to completely remove the tumor with clean margins, no microscopic cancer cells left at the edges. It's the gold standard for a curative surgery. On top of that, they got a 70% pathological partial response. The key scientific finding they really hammered home is that this combo therapy is transforming tumors from immunocold to immunohot by boosting immune cell infiltration. They're making resistant tumors responsive.
This ability to turn a cold tumor hot and act as a better delivery vehicle, that seems to be why their strategic alliances are so important. Maybe even more important than the lead indication itself.
Absolutely. The Catalent license, for instance, it's a non-exclusive global license to use certepetide as a payload to their SMARTag antibody drug conjugates, or ADCs.
And ADCs are one of the hottest areas in oncology right now.
They are. So by using certepetide as the delivery system, preclinical data showed they could get better tumor penetration and enhanced efficacy for those ADCs.
So certepetide isn't just a treatment, it's the infrastructure that makes other very potent drugs work better. That could open up a massive licensing revenue stream.
Correct. It completely changes their business model from single product sales to platform licensing fees. And then you have the AI collaboration with GATC Health.
How does AI help a company focused on pancreatic cancer?
It's a force multiplier. The AI platform can analyze these massive data sets to find new indications where certepetide might work, even outside of oncology. It just optimizes the whole discovery process. They think several new candidates from this will move into the clinic in 2026.
So it's the ultimate capital light strategy. Use tech and partnerships to diversify without taking on all the risk internally.
You got it.
So to sum up this contradiction, we've got an earnings beat, tight expense control, 5 complete responses in deadly pancreatic cancer, accelerated data readouts, platform validation from industry leaders like Catalent, and a runway into Q1 2027.
And yet the stock is down 27% over the last year, even while the biotech sector ETF, XBI, is up 24% in that same time.
So it's seriously lagging. You can understand the CEO's frustration when he says the market is missing everything.
He's blaming macro pressures, the stock's low trading float. But the reality is the market is focused on one thing.
The tangible financing overhang.
Precisely. Investors aren't skeptical of the science, they're skeptical of the financing execution. The runway to Q1 2027 is irrelevant when the phase 3 bill is so massive. The market thinks that even if the data is spectacular, maybe especially if the data is spectacular, they'll be forced into a highly dilutive raise to pay for it.
Because success just accelerates the need for capital.
And that brings the financing fear right to the forefront.
Which brings us to our segment where we try to find an opportunity in all this chaos. And for the record, this is absolutely not financial advice.
We're just putting on our hedge fund analyst hats.
And pitching an outrageous but plausible trade idea. So the stock dropped 12.3% on pure financing fear, despite great data and a beat. Analyst price targets are still way up there, between $13 and $21.
A huge gap between scientific value and market price.
The pitch is simple. Initiate a directional long position in LSTA immediately. Use this post-earnings drop as your entry point. The thesis is that this negative reaction is a clear overcorrection based purely on the fear of future dilution.
The market is betting against success, and you're betting on the data.
Correct. We are betting on that dense catalyst map, specifically the upcoming BOLSTER data in Q4 2025. That's the immediate event that isn't related to financing. Strong, positive BOLSTER data, followed by more good signals from ASCEND early next year, will force institutional investors to reevaluate the whole risk-reward picture.
The scientific momentum will temporarily override the financing anxiety.
And in a strong M&A environment, solid phase 2 data can force a potential partner's hand, which gives Lisata better negotiating leverage.
Exactly. The trade targets a rapid snapback toward those higher valuations, and it strengthens their position to get a better partnership deal.
The risk is obvious. It's a binary bet on data execution in the next 4 months, but you're buying proven scientific value at a price that only reflects capital risk.
A compelling, high-octane trade idea. It really captures the tension of this call. Lisata is executing, they're generating excellent data, the platform clearly works, but the market is prioritizing that late-stage financing hurdle over the current scientific momentum.
It's frustrating to watch, but they have laid out their preferred path.
And this raises a final question for you, the listener, to think about. These alliances with Catalent for ADCs and GATC for AI, they effectively stretch certepetide from a single asset into a broad, multi-indication platform technology.
Right.
So given the consistent positive data we're seeing across multiple tumor types, does the overall platform potential now exceed the value of just the late indication in pancreatic cancer? And if it does the most likely outcome shift from a dilutive raise for one trial to, say, a comprehensive platform-wide licensing deal, or maybe even a non-dilutive acquisition targeting the mechanism itself?
That's the real value proposition the market has to eventually price in.
It is.
A powerful thought to consider as we head into a very data-heavy period in Q4 and Q1. We will definitely be watching those developments closely.